Well, good morning, everyone, and welcome to day 4 of our week-long series of webinars entitled Tidying Up the Tax Year and Beyond. If you missed day 1, day 2, or day 3, you can pick them up on our website. They're all recorded, they're all there ready to go, so please do pick them up. There's some great content on there, some great panelists on there, and today is no different. As you can see from your screen, we have 1, 2, 3, 4, 5 panelists for us today to take us through today's session, which is the 7 myths and misconceptions of EIS and SEIS. Sounds very cryptic, I know. So what is it all about? So look, basically, over the years, we've heard countless misconceptions and myths around EIS and SEIS. Some are informed, some are just quite frankly plain wrong. So the idea of this webinar is to present an opportunity to set the record straight, put those myths to bed, and we've got 5 panelists here. We're going to identify 7 common myths and misconceptions. We'll delve into each of them as we go along and try and counter them with some facts and evidence-based responses. And this really was the genesis of our seminar. Remember those? A seminar, a live physical seminar that I used to run about 4 or 5 years ago. And it's based on the theme of cricket. And cricket, as you probably can tell, has got 7 letters in it. So every letter in that word used to be a different myth or misconception. And because I love my cricket, it used to have quite a big cricket theme and analogy to it, which I won't use today. You'll probably be glad to hear. But that was the genesis of this particular seminar. Hopefully, it will go very well. So we have an hour. I'll try and get you away by 11 o'clock. We'll certainly be done by 11 o'clock. So we have our panelists here. We'll go through the questions. If you have any questions yourself or you just want to add some comments, please do use the Q&A or the chat function down the bottom of your screen here. And apart from that, I've talked for way too long. So let's meet our panelists. Madeline, would you like to go first? Ladies first.
Thank you. Good morning, everybody. My name is Madeline Ingram. I'm Head of Investor Relations at Calculus Capital. And we created one of the UK's first approved EIS funds. So we've always been a growth-focused fund. So we're excited to be here today and talk to sort of debunk some of the myths that are out there about EIS.
Debunk, I like that word. It's a good word. Jeffrey, you're next. I'll go to you.
Hi everyone, I'm Jeffrey Foston. I'm the Chief Investment Officer at Jensen Funding Partners. Jensen, we started an SES fund when SES started, and then we created an ES fund 2 years later. And like Madeline, I'm here to hopefully help you clarify some common misconceptions. Thank you.
Cheers, Jeffrey. Neil, you're slightly different, so I'll let you go next.
Yeah, thanks,
Mark.
Thanks, Mark. Good morning, everyone. My name is Neil Cole. I'm Head of Wealth Planning Solutions at UBS Wealth Management. What that means really is putting together the panels of the products that we make available to our private clients in the UK. And a big part of that is our tax-efficient investing range, which has increasingly become a very important part of our overall product offering. So I'm here to, I guess, put a bit of an advisor skew on things and how we view EIS, and again, try and help tackle some of the myths.
Yeah, exactly. We have dirty, horrible fund managers here, and we also have an advisor here. So you're just balancing it out nicely. Thank you very much. Nick, over to you.
Hello, yeah, Nick Bird. I'm Head of Strategic Growth at Octopus. I work with a lot of firms, private banks like Neil, and all sorts of other firms sort of in between. Octopus Ventures are one of the largest ventures teams in Europe, and have seen significant flows into venture investing over those years, and see it as an increasingly common use of planning and investment opportunities for clients. So we really want to make sure that we look at the investment, not just the tax.
Always a good caveat. Thank you very much. Thank you very much. And Sanjeev, I guess you're got a foot in each camp because you've done both of the two things, fund management and financial planning. So I've done the introduction for you. You don't need to do it.
Yeah, thanks, Mark. So yeah, Sanjeev Gordon, Ventures Director for Renewable. We have one of the longest standing angel networks in the UK, and more recently have been doing EIS funds as well. As Mark mentioned, I was on the other side of the fence not too long ago, where I was a wealth manager, which specialised in kind of EIS, VCT, tax efficient products. I was then teased into the dark side and joined Renewable 2 years ago, and have since been kind of working at it from this side to demystify EIS investment.
I won't ask you which one's better. I wouldn't be as rude to do that. But so yeah, let me tell you how this is going to work. It's slightly different from some of the other webinars that we've done this week. So I've got 7 myths and misconceptions. I say we very commonly hear here at ESA. I'm sure some of the fund managers here as well. So we're going to go through each of them one by one and get these guys and girls to kind of counter or give their own views on some of the myths and misconceptions that we hear. So the first one, and Nick's probably touched on it already actually, so I'll go to Nick first on it. That we right here quite often is that EIS is just about the tax relief. It's got 5 fantastic tax reliefs. It's all about tax relief. Don't worry about it as an investment too much. Just get your tax relief, put your pounds in, get your 30p back. If you get £1.10 back, brilliant, off you go. Fantastic, that's a good deal, right? So yeah, Nick, talk to us about that.
Yeah, look, it'll be wrong to say that tax doesn't make an influence in terms of the behaviours of the client, and tax is a big influence on returns on everything. I think you can look at it from 2 sides here. It's actually what is EIS about? CDEIS about? It's about job creation. It's about growth. And if you think where it comes from the government and the guest revenue alongside that, influencing positive behaviours. And it's about creating that growth for UK PLC. It's very much a targeted piece of legislation. In fact, we sponsored a report a number of times, a high growth small business report, last one out in 2018. 1 in 5 new jobs came from those high growth small businesses. That's about 3,000 jobs a week. So it's an incredible sort of bit of additional help for UK businesses. I think on the investor side, it's an opportunity to get in at the beginning of investments. These, I guess in some ways you can look at all investment management. You can boil it down: buy low, sell high. The very nature of what we're giving you access here is the beginning to be at the beginning. The very nature of what we're doing as venture investors is about buying low. We can't help but buy low. Now that does bring risk, and it does bring opportunity, and I think the risk is compensated by the tax relief that you provided. But it should be a good investment in a good tax environment. And I think to the advisors that are listening in, or likes of Neil, both have to be relevant. One shouldn't forgive the other.
Sure, that's a great start. Thank you very much. Some great points there. Madeleine, it's probably a good time to come to you, because you mentioned in your introduction that Capitalist was one of the first EIS funds, all the way back there, kind of 25 years ago when EIS started. So it's probably a good question to ask to you in terms of how you see it as an investment kind of versus the tax relief argument.
Absolutely, yes, and I think that's something we've always done. I think, a lot of the market a number of years ago, particularly before the patient capital review, was focused on, perhaps a more tax-based EIS sort of structure. Everybody now has moved into the growth sphere, because that's really what HMRC want the money to be, driven into. But that's actually something that Calculus did. As you said, back in 1999 with our first fund, we were always a growth-focused vehicle. We were always about the investment first. The tax was very much it was there and it was important and it was useful, but it did not drive the investment decision-making. And I think that's been something that's continued with us over the last 21 years and remains really important today. I think as well, when you're sort of looking at it as a wider question, it really is quite useful to look at this asset class as a diversifier. Small UK companies, you've got that significant growth opportunity, but equally there's often low correlation to other asset classes that might already be part of a client's portfolio. You've got other arenas. We've seen COVID over the past year, huge pandemic. Small companies are frequently very nimble. They're able to change quickly. We had one business in the current portfolio that's actually the travel sector. So you kind of immediately think, oh, goodness me, that's it. Probably going to go pop. But actually, because we had strong management and because the company was able to move and shift and change, they've actually had a reasonable year. And now they're set up for a really, really strong year. So small companies can change and develop and switch things around, I think, much more quickly than larger entities. So there is, again, another benefit. It's a different type of risk than you would have, say, within a public company that might form part of your pension portfolio. So definitely not all about the tax. It is all about the investment, but the taxes are useful. We've just looking back over this last couple of months, our last exit was a fantastic 6x return from a company called ActiveOps. Excellent, no capital gains tax to pay on that. But equally, the one before that was a write-off, a company called Chopped that didn't do so well, and that was in the in the casual dining sector, which we all know has suffered lately. But then you have the loss relief there, so it can't drive the investment, but it's definitely useful. So it's worth keeping it in mind.
Yeah, I often think it's kind of it's almost at a disadvantage buying 5 tax reliefs in one. It kind of moves the focus away from the tax when it should be on the investment. you made a lot of good points there, Madeline, but one of them was around kind of pre-patient capital review and what's happening in the market at that point. So perhaps go to Neil on this one. Obviously, a while ago, the market did move a little bit, and it wasn't perhaps so much about growth investments. It's more about renewables and perhaps just getting the tax relief and getting kind of the more risk mitigation effects of some of those investments. So do you want to talk us through how the kind of market's changed in the last 5 or 6 years now?
Yeah, definitely. Gives me an opportunity to be a little bit smug as well, because at UBS we were quite late to the EIS party. We only launched in 2013, and I think being a little bit late allowed us to really review the market and the sorts of products that were out there. Also have conversations with the likes of the Treasury and our contacts at HMRC to sort of understand how EIS worked and which direction it might be moving. And we took a view then in 2013 that it should be all about the investments and not about the tax structure. So actually we didn't go down the kind of the renewable, the asset backed, or the planned exit, which is an awful term that I've always hated. So we never actually put any of those in front of our clients, and instead looked for managers that we saw as being far more comparable with private equity. And we made it available on our product shelf to our client advisors, so our investment advisors, as an investment option that sits alongside all of the other products on our advisory shelf. And I think the first set of rule changes was 2015. So about 2 years after that was then when we started to see the death of the sort of the old style structured funds. And I think that was kind of really helped justify the decision that we'd made. And we saw the whole market shift towards looking for these good quality managers that can find early stage companies and genuinely put money onto the balance sheet of these businesses and help them grow, which at the end of the day, coming back to those conversations with the Treasury, is exactly what they want. As long as EIS is putting money onto the balance sheets of growing UK businesses, then EIS is doing exactly the right job and is completely in line with, I guess, government policy.
Brilliant. No, that's a perfect response, I think, really. So I think generally from Nick and Madeline, Nick, we perhaps covered that one off. So put that one to bed, hopefully, in terms of it is more about the investments. And particularly at the moment, there's some fantastic opportunities on the back of COVID and what's happened with COVID to invest in early stage businesses. So it really worth looking at in the investment side. And obviously the tax is nice to have, the tax reliefs are nice to have, but the investment is what it's all about. So we'll take that one off. That one's done. Sanjeev, Jeffrey, I'm not leaving you till, well, I'm leaving till last, but I'm not leaving you out completely, I should say. The other kind of myth or misconception we come across quite often is that research, due diligence is just way too difficult in this area. It's a small part of an advisor's time. And so it's difficult to do a kind of a comprehensive research and due diligence in this area. What can you do as fund managers to try and help advisors do some of that research and due diligence? I'll go to you, Sanjeev, first, because again, you have 2 foot here.
Sure. So yeah, I think the key thing around this area is really buying into the investment thesis for any of the funds that you're looking at. So it's not necessarily just looking at their assets under management or looking at the kind of the exits that they've made, but also the key thesis, especially because you're investing in what they are kind of seeing over the next kind of 4, 5, 6 years plus. And that's even more relevant in EIS, where you are trying to place investments now to look out that long-term kind of growth. Where is the innovation coming from? Where is and it's a buzzword used very often, but where is disruption in terms of how people are going to be working, living and communicating over the next several years? So you'd really want to be buying into that aspect and making sure you know and understand and are comfortable with the type of investment thesis that a fund manager has. You want to be looking at the financial stability of that fund manager, making sure that they as a company are going to be around for that period of time, because you don't want to be investing in a fund manager whose financial stability may mean that actually 2 years down the line, they might not be there. So you want a fund that is able to kind of grow with the actual investments themselves and secure the team. And that leads me on to the final part. You want to be actually looking at the same way we as fund managers look at the investment team. You want to be looking at the team. Who are the guys and the team making the investment decisions? How are they actually selecting or sourcing, selecting and supporting the businesses? And the final part is the supporting. At this end of the market, as I can see a few of the other guys kind of nodding, we're investing in a journey in the businesses that are going on this journey where they need a lot more than just capital. They need the kind of mentoring, the advisors. They need to be able to tap into kind of additional services to help them get to seed, post-seed, Series A and beyond, by which point they really value that support, not just the capital. So they're the three kind of key areas that I tend to look for, or I used to look for, and now make sure we are promoting out there as well.
Sure, that's great. It's a great starting point. I guess, Jeffrey, I was just going to you. What kind of resources do you have for advisors who are kind of looking to perhaps look at your fund or look at other funds?
Yeah, I mean, I think those are really good points, Sanjeev. And one other thing I'd say is that, look, yes, there is research and due diligence to be done, but you can also direct the advisors to kind of some of the resources out there, like the MyCaps, the Allen Bridges, the Hardmans, those reports that you can actually refer to really give you an understanding of not just a specific fund manager, but how they are positioned relative to the entire market. So I think that's something that I would definitely encourage advisors to use when they're trying to do their research into the space.
Absolutely, yeah, that's a great one. Jensen and Sales, do you kind of provide them with, because they'll send you perhaps a due diligence questionnaire, for example?
So we have, yep, absolutely. We've got a standard questionnaire that we send out to advisors, and I guess some advisors that actually are slightly familiar with it requested, but we have a preset document that we send out to all advisors, giving them exactly all that information, exactly like Sanjeev says. What's our investment thesis? What's our strategy? How do we support companies? What sort of companies we look at? What stage do we invest in? And what sort of exits we've received, we've managed to achieve to date. So yeah, it's a pretty standard process. It's very easy for advisors to reach out to, I'm sure, any one of these fund managers and get that information from them.
Sure. So you're trying to make the advice process as simple and easy as for advisors to pick up and run with.
It's very, very, it's all laid out for them.
Cool. And Neil, I can't go past this question without asking you something about research and due diligence, because it's pretty much your day job. So, so you, again, on the other side of the fence, as a wealth manager, what kind of questions are you asking these guys as fund managers? How honest are they? How transparent are they?
Yeah, so certainly on the first bit, very similar to Sanjeev's answer, actually, we're mostly interested in how the managers work with their investee companies after making the investment. I think it's really clear to make the distinction that an EIS fund isn't a stock picking fund, which obviously in sort of normal investment world you would have, where you back a company and then you sit back and hope it grows. It's what we like to see is very active management, so hands-on investment management, where the EIS manager is hopefully putting somebody on the board of these companies, helping influence them, getting true oversight of the performance of that business and helping it grow, and then most importantly helping negotiate the exit, because I think one of the hardest things in the EIS world for an entrepreneur and a small business owner is to actually exit that business and return funds back to their shareholders, and that's where EIS managers can be really helpful, because they've got decades, hopefully in most cases, of experience of helping these businesses in terms of knowing what their options are from an exit, but then also helping negotiate and getting them good terms as well. And that's really vital for our clients, because we don't want to see our clients stuck in EIS funds for 10, 15, 20 years, stuck in zombie companies that they can't get their money out of. We want active managers who are getting into businesses, growing them, and then exiting them before they reach that kind of maturity point.
I say this is your day job, so you're doing this every day. You're looking at funds, you're looking at EIS funds, SEIS funds, and VCTs, I know as well. But for an advisor who's not looking at this every day and perhaps just picking it up at a tax year end and just wants to perhaps maybe you've got hundreds of clients, perhaps you've got 4 or 5 clients and you want to do it quickly, but it's an important part to those particular clients. What advice do you give to them if they just want to look very quickly across the market and choose 1, 2, 3, 4 EISs to go into?
Well, I think now the market's matured to the point where there are tools that allow any advisor to do that. I know MyCap's already been mentioned. I think MyCap's an excellent tool for fund comparison, relatively affordable. I think it's the first time kind of research in this area has become quite affordable for advisors. So it can allow them to go on, sort of put the criteria of what they're looking for, compare funds, and then keep an audit trail as well that helps them sort of, I guess, demonstrate how they've got to the fund that they've recommended. It's not so relevant for UBS because we obviously have a kind of a much more detailed research process that sits behind it. But for an advisor that is just sort of dipping into VCT and EIS and not doing it all year round, I think MyCap's an ideal tool for that. Yeah,
and it's always good to have a look at the whole market and not just go to the kind of the biggest animals in the zoo. So it's always good to see who's out there in the market, I think.
Absolutely. Yeah.
Okay, so we're 20 minutes in. We're 2 of our 7 down. So let's move on to our third one. You're going to love this one, I'm sure. Look, the returns aren't great. They take too long and there aren't enough exits. Madeline, you've mentioned exits already. So do you want to pick that one up?
Yes, yeah, and I think there's quite a good segue there between, when you're looking at comparing different fund managers and how to perform the research due diligence that you want to do. I think one of the things that we've always found when speaking with different wealth management advisors is often the looking at actually achieved exits is something that's really vital. I think between us all, we'll have very different ways that we value companies. So our portfolio valuation processes may be different. And it's, as everybody knows, it's evaluation is a wonderful thing, but it means nothing until you've actually sold a company. So often an exit track record, actually delivering cash back to investors, is something that I think hits home with advisors and clients when they're assessing whether you might be a suitable fund manager for their particular client. So I think exits is vital. They happen often. We've had 5 already this year. There are occasions that it does take longer than normal. I would say one of the myths that people have today, and I think this harks back to pre-patient capital review days, is some investors still believe that EIS is 3 years in a day. It goes back to the solar sort of investments that were made, which were very structured and which perhaps did enable investment, on the 3rd of April for the tax year. 3 years later, they would exit. Growth investing is not done in that way. And it is a longer term focus. So you are looking at perhaps 5-7 years for a company prior to exit. So I think that's one of the things that we've often tried to get across to the market, since we started in 1999, really. It's easier now because everybody's in the growth space, and so you're not comparing against people that do have that sort of 3-year option. But for those advisors that are kind of, as Neil said, dipping in and maybe don't do this as regularly, we really are trying to hit home that it's not a 3-year thing. It is a longer term investment, but it's a very valuable one. It's a great diversifier to what's going on. The tax release are phenomenal, but it is longer term. So I think that's the thing I'd put across, really.
Sure. And you mentioned, because there are exits and exits in the EIS world, you mentioned an achieved exit. That's where an investor's actually getting cash back into their pocket. Indeed.
Yeah. Yes. So and I think that's the one to really look at. Valuations are great, but they're a number on a piece of paper. So actually looking at funds achieved exits is really vital, and what they've actually delivered cash back. Or in our case, we've got a reinvestment fund. So what we try to do is get that investors' money to come back to us again. And as Neil's nodding here, because we've got quite a few clients doing that at the moment, which is great.
Sure. And Sanjeev, I guess on the exit side, because I know you've done a lot of work with angel investors as well. Have you started to see exits come through? Are they becoming more prevalent now at the moment?
Yeah, absolutely. So I think it comes back to some of the points I made earlier on. It really is a matter of managing those investments to get them to exit. Now, in some cases, like we had a couple last year in which we exited prior to the 3 years, but that was because we were on top of the company. We were looking at exactly where that company's got to and the growth, what we were achieving, albeit within 2 years, which means no tax, but it's still a good growth. And actually, if we remained in that business, it was increasing the risk, which we weren't comfortable with. On the flip side, we've held investments for 8 years and returned 14 times return on capital. So it really is an individual basis, but that links into a point which I've had to actually speak to a lot of newer advisors coming into this market. The way the EIS fund structure is worked, it's not a closed fund in which the full 10 years or whatever has to be completed until any money comes out. It's actually on an individual deal by deal basis. And quite a lot of the newer advisors are surprised by that. So when I'm talking to them about actually, yes, you'll get exposure in this fund into between kind of 7 to 10 companies, but actually you may see a return in 3 years time, 4 years time, 5 years time, depending on when we exit each individual business, not when we exit all of the business, then return the money back to you. So I think there's a bit of kind of debunking the myth there as well, using Madeline's word, to kind of make sure people, especially the newer advisors, understanding how the structure works. And actually it's more of a pooled investment structure because of the nature of the EIS policy rather than a fund in a true sense.
Yeah, I think it's good to be able to set expectation levels for investors when they're coming into this thing. I just want to clarify one thing you said, because you said, I think one of your investments return money within 3 years. So just to make it clear that there is a clawback of income tax relief.
Correct, that's right, yes.
Yeah. Hopefully if the exit is big enough, that kind of makes up for the clawback of relief.
Well, that's what you're looking at. So it's exactly that, right? You're trying to manage your exits. In some cases, there can be opportunities, albeit very rare, and you don't want to kind of be looking at that, but you want to be making sure you're ignoring the tax to a certain extent, and it's actually a good investment on its initial own basis. And then when you're exiting, it's a good return without the tax. Once we looked at kind of the tax relief clawback, it still made a lot of sense for us to come out of that business and give our money return back to the investors.
Sure. Sure. And then one other thing I want to pick up with Nick was a kind of track record. I know when advisors talk about, well, the industry talks a lot about track record. What does that mean to you? I think Madeline's mentioned we've kind of done exits a little bit in terms of valuations as well for companies in the portfolio as well. How do you value those? How do you kind of confirm your track record to someone like Neil, for example?
Yeah, I think I'd echo some of the other points about this is about patience and about portfolio. And as I say, I think it is about sort of those sort of 10 to 15 companies that will perform quite differently, really. So I think there will be a big divide between success and failure. So failure often is to nothing. And so it's not, oh, I'm sorry, it's dropped 10%. If a company is going to do well, it will do well. And I guess success is a multiple, not a percentage point. And that's where I think you get your huge difference through. So I think when people look at the performance of these types of investments, if you had 10 companies, 5 did badly, 5 did well, you have done amazingly. Because of the nature of that perhaps sort of disproportionate way that the different sort of returns come through. Valuation, these are obviously private companies, so they're not, there's no sort of mark-to-market valuation. You might get some interim valuations where there's perhaps new share capital coming in. There might be new funding rounds that's giving it perhaps a new and an increased price. But I also very much agree with the previous speakers that exit is all. So the value is the value once someone buys it. And that's really sort of true value. Nothing is worth anything until it's bought. And that's where, again, that patience of that coming through provides it. And I think, yeah, again, Neil was talking about the exit side. We talk an awful lot about, I guess, about venture investing, about not being a level playing field, actually. Not everyone gets to buy the same stuff. And so it's really important that you get a good roster of potential. But it's also having that exit opportunity. Now, we've sold businesses that you might have heard of, but you've definitely heard who we've sold them to. So we've sold to Google, to Amazon, to Twitter, to Microsoft. Yeah, that's the sort of environment you want to kind of create, because everyone can buy. It's not always that easy to sell.
Yeah, cash in the pocket is always the kind of benchmark that I would use for that. So that's perfect. So thank you very much. I think we covered that one up as well. So we're 3 down, which is good. Next one, our compliance officer / our PI firm says that this area is just way too risky. Let's not advise in this area. Let's just ignore it effectively. If that's true, Neil, you working for a Swiss risk-averse company wouldn't be advising on EIS and SEIS, I assume. So talk us through kind of why you do look at this area.
Very true. I mean, it's this is the one when I look down the list that is the absolute myth. I think it's a bit of a cop-out, and I think a lot of people are getting their ideas mixed up when they say it's going to ramp up my PI premiums. I just can't afford to offer advice. It's too risky. When you look at the complaints data that comes out of the FOS, VCT and EIS are ridiculously low. There are very, very few complaints, very few issues about VCT and EIS because they are genuine, well-managed investment vehicles as opposed to being aggressive tax schemes. And I think if you're an advisor and you've had a conversation with your insurer or your broker who says, oh no, not going to touch that with the barge pole, I think you need to have a serious conversation with them about what a VCT and EIS is. This isn't some aggressive tax scheme that's going to have to cause a huge liability further down the road. If that doesn't work, then I suggest getting a new broker, because there are plenty of brokers out there that will cover you for advice for VCT and EIS without hiking premiums. And you're absolutely right from a UBS point of view. I mean, it was a no-brainer for us that we wanted to get involved in this space. Clearly, we looked at it very carefully, as I mentioned earlier, when we launched our new offering in 2012-13. We went through some quite detailed kind of compliance reviews to make sure that we were comfortable with it, and there was never any doubt really. We saw it as being a key part of what we want to offer our clients. And I think we would really be missing out if we didn't. If we took the easy option and said, no, EIS is too complicated and too risky, we're not going to do it, then our clients are going to go elsewhere, because there are plenty of other advisors that are working in this space.
Sure. And I know we've done a lot of work with PI advisors to try and tell them about what EIS is and how it works and how it operates. So I think most of the big ones understand what it is now. I know the PI market's a little bit broken for IFAs at the moment, I'm sure. I'm sure the IFAs are probably nodding their heads at that one. I want to talk about risk, Jeffrey, if I can with you. How do you kind of talk to clients about risk? How do you kind of pitch EIS in terms of a risk investment?
I guess at the end of the day, all investments, like we said earlier, it's about the return. And if you think about where the SES and EIS investments or that landscape is in relation to the more advanced equity, these venture capital and private equity markets, it is higher risk. It is a higher risk investment. One of the things I'd say is one of the things that we find we speak to advisors about is understanding how these investments are structured and how they fail. A lot of the advisors don't understand, and like Nick said, look, some of these companies are going to fail, and those that fail first. So most new advisors, the first instruction you have from them is, oh, how come has this company failed? You know, why is this happening? You know, I thought this was supposed to give you a nice, great return. And I think making sure they understand that risk and the risk of those failing and how that is structured is really, really important. It is higher risk. It is earlier stage investments. And the way we try to explain to advisors is say, look, we promise you a return of 1.85 times, and that's based on a certain structure. It's based on a certain percentage of companies failing, a certain percentage of companies kind of doing well, and then, you know, the balance of the companies retaining the entire portfolio. And once we explain that to them and manage their expectations of that risk, I think that's how we try and get that across to the advisors.
Sure, I think it's a tough one sometimes. We often say that the lemons ripen before the plums. So the ones that are going to go bust early, and then the ones that are going to do well, obviously going to do well much further on. But it's hard for investors to lose money early and hold on, if you like, to get those bigger returns later on. So it is a bit of a journey you've got to go on. But again, I think it's just trying to set that expectation level for advisors when you first enter the investment. Yeah,
it is one of the comments that when we're speaking to advisors, it's kind of a realization for them. Oh, right, I didn't realize that that's how it would be structured. So it's one of the things that we have to explain to most advisors.
I can well imagine. Yeah. And Sanjeev, is it the same for you when you're talking to advisors about the risk versus return kind of profile? Again, how do you pitch it to them?
Yeah, I think it comes down to actually, first of all, making sure that they understand. So when I was on the other side of the fence, it was always actually, we used to have this quite a lot. Oh, actually, yeah, I'm going to invest £20,000. I'll be looking to kind of take that and do something with it, either buy a house or do something in about 3-4 years. No, that's not the kind of stuff you want to be going into. You want to be looking at this, actually making sure this is the kind of money where you understand that you are actually in for a loss, potentially in for a loss, but understanding how that fits a wider portfolio. And it comes back to using something like the kind of the barbell investment strategy approach. So making sure that you understand which parts is on your risky side, probably reducing that if you're not too comfortable with it, and balancing that out with something that's going to be a lot more kind of maybe cash funds or kind of a little bit more income generating assets. But yeah, this asset is not one of those that you can kind of go into and say, yeah, it's just going to be high growth. Anyone who's doing that is not kind of advising their clients correctly.
Yep. Good points. So I think we cover again the kind of the client's PI aspect of, as I say, anyone who's having trouble with their PI insurers, please do talk to us, because we've done quite a lot of work with PI insurers to try and get them comfortable with this area. So we can pick that up, absolutely. So next one then. So the EIS, SEIS, they're just tax avoidance schemes, right? Nick, I'll go to you now.
Simple, no, they're absolutely not. I think it's one of the simplest ones that we've had there, that they are well-established government-backed legislation, and for many, many years now, through different colours of government as well. So I think that it's been supported through different governments, and has seen the success of it come through, has meant that it's been a constant addition to UK PLC. You know, look, we've got a lot of difficulty with smaller businesses being created by the pandemic. Pre that, you know, Brexit was the big story. Almost be a delight to get Brexit back on the front page again. I can't believe I said that.
Too much leaves on the front page at the moment.
But I think from that, what is that about? Is again, it's about what is the lifeblood of an economy. So yeah, we work for particularly someone like Neil works for a very big company and so on, think big employer, but actually the lifeblood and actually the backbone of the UK is actually down to lots and lots of smaller businesses. And I think it promotes what we have is a fantastic entrepreneurial spirit in the UK. You know, we dominate in actually, you know, to mention Europe, we dominate in Europe in terms of funding levels way in excess of Paris and Berlin and those sort of centers. You know, we're not quite sort of a Silicon Valley, but yeah, that relief and that structure has provided a really positive outcome for UK PLC as well as investors.
Sure. And I guess, Sanjeev, you could align the EIS with or liken it to a pension or an ISA, for example.
Exactly. So it's the tax wrapper. And in the UK, we have multiple tax wrappers. If an advisor is looking at their toolkit consists of EIS ISA, pensions, trust planning, all these are wrappers, they're not investments. It's the underlying investments that kind of form the type of kind of returns and losses, etc. that you're looking at them. These are wrappers. Now the UK has generous tax wrappers, all working in different ways. So you need to take into consideration which tax wrapper has what benefits to it and how does that form a part of the client's portfolio. Not just debunking, not just looking at this and thinking, oh, actually, yeah, it's a tax mitigation scheme at all. It's actually, these are the toolkits that we have as, or advisors have, use them in a way that's suitable.
Sure. And Nick's already mentioned, obviously, this is on statute, this is on legislation. If we want to make any changes to the scheme, we have to go through a horrible process to try and get any changes done to the scheme, which used to involve the EU, which thankfully doesn't now. But also, Madeline, there is a process called advance assurance. Now, 5 or 6 years ago, I don't think anyone knew about advance assurance, but now having that golden ticket for advance assurance is so important. Do you want to tell us why that is?
Yes, of course. So advance assurance, and I'm sure with the same as the other guys here today, you want to get that advance assurance prior to making investment. It's something that we always commit to. You're going out to the revenue and you're saying, this is what we're going to do with the company. This is how much money we're going to give them. This is what they intend to do with it. And it's up, it's there up to them to check that is in line with the spirit of EIS. We've not had issues. I mean, as I said, being a growth investor, continually since 1999, it's been something that's been a fairly easy sort of journey for us. But it's an important step. It makes sure that everybody is playing by the rules. And again, it's that feeling of not just following the rules, but also the spirit of the rules. And that's where I think as an investor or as an advisor, it's really important to dig into the underlying companies that form part of a portfolio. Sanjeev mentioned that the term fund is almost a bit of a misnomer because actually it's a collection of investments. But if you look into some of the investments that form part of not just ours, but the other guys' portfolios as well, you can see the good that they're doing to the UK economy. I mean, a third of our portfolio is biotech. It performed incredibly strongly, but also it did amazing things throughout the past year, to help the pandemic. And that's small UK companies that wouldn't have been able to provide that assistance had the EIS structure not been in place. So actually sort of looking at the underlying companies as a client or as an advisor and seeing, oh, right, okay, that's going to go and, hire 30 more people. That's going to help transform immunotherapy vaccines in cancer. You can start to sort of see why HMRC and the Treasury would want these companies to grow and succeed. So I think there's an element of when you're doing your own due diligence, it's kind of looking at it from HMRC's perspective and understanding it and saying, yeah, I totally get it, actually. I understand why that's helping the UK to excel. And all these are just great examples. And I know ESA, you've done a great job with ESA, actually collating some of these examples to deliver those to HMRC and HMT so they can see, live in action, examples of EIS qualifying investments where the Treasury's actually made a return on investment. If you look at the national insurance and the PAYE paid by employees that are hired because of EIS investments, you start to look at it as actually an investment for the government, which is paying off. So, there are wonderful reasons both for clients, but also for the government and for the UK as to why this structure will continue to be backed and has been backed historically by multiple different governments in the past.
Yeah, I think that's why it's super important for HMRC and governments to see kind of the end results, because they normally see the company through the advanced assurance system. So just to explain, the advanced assurance system is whereby a company who wants to qualify for EIS goes to HMRC, gives them their business plan, gives them all their ideas, gives them their cash flow to make sure they're going to qualify, or more importantly, their investors are going to qualify for EIS relief when it comes to 4 months of trading. So it's really important for them to see what actually happens to those companies and how they go on to fulfill their business plan and grow their ambitious ideas. So Neil, I guess from your point of view, again, you wouldn't invest it into a company that hasn't got advanced assurance, I'm assuming.
Well, we don't invest in the companies directly. We put our money with the managers. So I guess a part of our due diligence process, coming back to the research question, is understanding how the managers approach advanced assurance. And I think it's pretty much uniform now across the industry that they're not going to go ahead and deploy cash into a company unless they've got that assurance, because of the headaches that would inevitably come with it if they find that actually that company's not qualifying. So it's I guess it's just a part of the rigor process that we make sure that our managers have, that when they're doing their own research on the companies before they write a check, they're confirming eligibility, they're getting that sense checked, and then importantly, they're getting it approved by HMRC.
Absolutely. Okay, so I think we're done with that one. Let's move on to number 6 now already. So look, EIS and SEIS is only for the super high net worth, you know, the completely rich people out there. It's not really kind of for anyone below that. Jeffrey, I'll go to you on that one. You're on mute, Jeffrey. First time today, someone's done it. Are you still on mute for some reason? That's better.
I was pressing the wrong button. That's why. I think it's like Nick said. No, that's not true. It's as simple as that. But seriously, listen. These investments have to be made by people who are sophisticated enough, or can afford to lose the money, or smart enough to know how to invest in these underlying companies. And I think that's a measure that that needs to be taken. You don't need to be a super high net worth person to fall into that category. We do have, and I'm sure the other fund managers do, we do have limits on the minimum investment to be made into our fund. And that is, again, to make sure that, we are meeting those requirements. So ours is £10,000. It's the minimum requirement. I think that so long as the investors have a tax liability and understand the risks that are involved, I think that is a measure of what it would take to get involved. Yeah, again, it's very simple. You don't need to be super high net worth to do this.
Absolutely. I guess it's trying to identify appropriate clients that these type of investments are for. So again, when you speak to clients, Sanjeev, about these type of investments, do you talk? I've seen you talk about attitude to risk. You talk about capacity for loss. Do you want to kind of pick up the process that you talked to them about?
Yeah, it's exactly that. Like when you're looking at clients for EIS investments or any investments, you are looking at attitude to risk and take into consideration capacity for loss in that as well, and then overlaying that with time horizon of investment. So once you put all of those things into place and actually put the portfolio plan in there as well, you can really start to put EIS type investments into a portfolio, even if they're not ultra high net worth, but they're sophisticated and they have to understand this type of investment. And I come back to the point I made earlier on about the barbell approach for investing. If on and all of the advisors listening in will be doing their risk questionnaires with each client, and a client will come out at between a risk of 1 to 9, they'll come out at 4 or 5. And in those kind of cases, some advisors will just steer totally away from any potentially high risk investments. But actually, it's a matter of you're doing your clients disjustice, because actually what you should be looking at is across the entire portfolio that they have, putting some of those into lower risk, income generating cash funds, etc., and then offsetting some of that with the exposure to high growth to balance out an entire portfolio. So that's where you should be looking at it, not just in a single individual. Oh, this individual is a risk level 4 or 5. No, we can't be looking at it.
So it goes a little bit deeper than that. It's not just about the risk aptitude. It's about kind of various other factors as well, in terms of what they're trying to do with their financial planning in total, what they're trying to do with their assets, how much assets they have, how much income tax liabilities they have. I guess it's slightly deeper than just a risk question, is it?
Yeah, absolutely. You've got to take into consideration so many things. And that's why advisors are kind of there to do what they need to do. Take all of these different points into consideration and then use whatever tools they can in their toolkit to make sure they've got the exposure to growth whilst also managing risk.
Sure. And then Neil, how do you, within a client bank, how do you identify clients that this might be appropriate for? And I'm sure you do client segmentation, all those good things. How do you kind of pick out and say, actually, this group of clients might be EIS applicable or appropriate?
Yeah, so coming on to a very good point by Sanjeev about portfolio construction, because I mentioned earlier, we put EIS on the product shelf alongside all of our other investment options, including our core kind of discretionary service and all of the various products that we can offer on an advisory basis. And we view EIS as being what I guess you'd call a satellite investment, so a kind of, a relatively small part of an overall portfolio. But what that means is exactly on Sanjeev's point, is you don't have to have a super aggressive attitude to risk to be suitable for EIS, as long as it's balanced with everything else that you're investing. And that's where the important thing is the whole portfolio that's being recommended, not just the EIS in isolation. So coming back to our clients, I mean, generally any client that clearly they need to be eligible in the first place, so a UK income taxpayer, they need to be prepared, as we've said, to go into something over a bit longer term and not necessarily a known term, coming back to the point about time horizon. So they're prepared to invest for 5 years plus, really. They understand that this part of their portfolio is going to be higher risk, but in balance it works as part of their overall portfolio. And actually, when I help our advisors do their book screens, you get a surprisingly high proportion of our client base that I think is suitable for EIS. And I really think that it's a growing area, and as people get more and more comfortable with it, there will be more and more people investing in this as a small way of diversifying their portfolio into something very different and very uncorrelated from everything else that they hold in their portfolio as well.
Sure, no, that's a good point, because I think the figures have been quite flat for the last 4 or 5 years in terms of the number of people that claim tax relief for EIS, which is obviously a good indicator of how many people are investing in it. So it's been about 33,000 for the last 4 or 5 years. Nick, in terms of trying to grow that market and help advisors or get more advisors into this area, because one of my bugbears also is that this is called an alternative investment. I hate the word alternative investment. I don't think it is an alternative investment, but how do we get more advisors to kind of advise in this area and find more clients to be able to put this stuff to?
Yeah, I'd absolutely agree with you in terms of sort of terminology there. I think I hear tax-led, I hear complex, and I don't like any of those sort of terms really. I think it should be about the opportunity set that is there. So you mentioned risk before. I mean, risk is not a bad thing. Risk is the opportunity for return. I think the other bit here is almost a little bit of scarcity. So the ability to get into the investments that we provide is a bit of a key to the door that's normally locked. So yeah, I would love to be an investor in private equity. Now, unless you've actually backed to the super high net worth, unless you've got loads and loads of money to find those individually yourself, you will not get access to that. So we've invested into firms like Zoopla and Grays, and Kazoo as one of our most recent sort of exits. Now, you'd have never had the opportunity to invest into that company yourself, but you do via us because of the world we get you into. So I think in some ways, I know when I've done sort of client events and so on, that you see sort of the eyes widen a little bit from the investors sitting there going, right, this is something new. This is something that doesn't sit in my pension or my ISA or my actual or my anything. So I think it should be about that sort of that greater understanding of where the opportunity lies to be part of something that is different. So we've all mentioned portfolio planning, diversification, all those different things. So I think there's an education bit there for the clients. There's clearly education for advisors just to be more comfortable with the process. And I think that Jeffrey was mentioning before about go in eyes wide open, that you understand what that process will look like. It is likely that the first letter you have will be a failure rather than a success, but don't be sort of put off that. Understand the longer game and the portfolio planning from that. So yeah, I think there are so many good opportunities to get involved with. And I think that giving a retail client access to something that is very exciting, I think that opportunity shouldn't be missed. They don't have to do it, but they should know about it.
So we're all very cool, sexy, and exciting in the EIS world at the moment. That's what you're saying.
Yeah, exactly.
Exactly. Yeah, that is interesting because obviously we have Dragon's Den and things on the television that kind of look at all this stuff and do, as I say, mainstream it a bit more. I heard you hear quite the stories of folks down the pub saying, "Oh, I've just invested in this new tech startup company." It's kind of what the stuff you want to be hearing these days. It is taking much more root in more of the mainstreams, which is great to hear. Okay, so last one, we've got about 10 minutes left. If you've got any questions, please do fire them through. If you've got any other myths or misconceptions that you think surround this area, then again, please send them through on the Q&A or the chat. But our last one is, look, it's really difficult to incorporate EIS or SEIS into a client's financial plan. Obviously, we know a lot of financial advisors, planners do cash flow planning models and things like that, which are super useful for clients, but it's difficult to incorporate SEIS, EIS into that. Sanjeev, I'll go to you first on that one, if that's okay. You're mute. Oh, there you go.
I was having some technical issues there. So. Sorry, could you repeat that last bit again? I just lost you then. I was trying to...
Yeah, just talking about clients' financial plans and how you incorporate EIS and SEIS into a client's financial planning.
Sorry, yeah. So I think the key point on this is and I've probably been harping on about this quite a lot, but it's, as advisors, you have multiple different areas to be looking at, making sure you're actually understanding, yes, I'm going to be investing in early stage opportunities, But within the early stage opportunities, at what stage are you going into there? You're going into seed, pre-seed, post-seed, kind of Series A level, understanding the differences on that part, understanding the differences in terms of the actual investment remit and thesis for the funds, and then bringing that back into line with the investor's actual underlying kind of portfolio to look at how are they actually going to be positioning for income, positioning for growth, positioning for getting exposure to this type of investments. As Nick said earlier on, we do provide that turnkey or opportunity for investors to get into this end of the market, which they wouldn't normally get. So yes, absolutely. One of the points I would add though is we are unfortunately kind of we're all assessed by the lower denominator of our industry, and unfortunately things like Dragon's Den and those individual conversations at the pub where individuals are making rash decisions or ad hoc decisions over a pint on making these types of investments, then going on to lose that, has unfortunately created a lot of scare in this end of the market. So we need to be, and you, Mark, are doing a great job on this, but educating a lot of the investors and advisors on how this actually works and making sure it's not being assessed or judged on those single deals that have been done over a pint, or looking at Dragon's Den and how those companies work. A lot of the funds here will be looking at true innovation and technology that is going to impact how we work, how we communicate, how we live over the coming years. It's not just a matter of a kind of a quick, sexy buzzword that is something that sounds interesting right now. It's actually making a true difference to the world and the economy and individuals' lives as well.
Sanjeev, I'm pretty sure every good decision I've made ever has been over a pint.
Yeah.
I'm pretty sure of that. I just want to talk about asset allocation as well, because obviously, advisors are trying to advise across a different range of assets and different areas, etc., etc. Again, how do you fit in a VC investment like this into a client's portfolio, which is slightly different, perhaps, than their normal portfolio? You obviously, pensions have blue chip funds, etc., etc. Madeline, do you want to pick that one up?
Yes, sure. So, I mean, I think as everyone has seen, we since the curtailment of pensions has actually been an even greater opportunity for that conversation to be had with clients. That there are the sensible core parts of any portfolio that sort of must be hit. And then when you are looking at other tax efficient means to invest, that's when EIS VCT should be part of that conversation. As Nick mentioned earlier, it doesn't mean that it's suitable for every client. It doesn't mean that every client will be comfortable with the risk and will want to do it, but it should be part of that conversation so they're at least aware that it is an option available to them. In terms of asset allocation, I think you're looking at it goes back to the barbell and looking at the entire portfolio and the structure of all of it. Have you got I suppose exposure to multiple different routes? If somebody's got a significant buy-to-let portfolio, that has a different risk profile, it has a different liquidity profile as well. You've got to sort of take all the different steps of a client's portfolio and assess it. And often the bit that might be missing is actually access to small growth companies. That's not something that naturally forms part of a client's portfolio. My classic one, when we had lots of client meetings, was always, I've met this guy at the golf club. So it was never the pint, it was the golf club. Mm-hmm. And it was, the advisor going, I told him not to do it. And, the client's gone ahead and done it. And actually that's then caused the next step to say, do you know what, if you are investing in a small business, it needs to be done properly. It needs to be managed properly. There needs to be, guidance on it prior to making investment. There needs to be someone monitoring that investment. And that's when often the next step is, if you're interested in this particular area, go to a professional, go to a fund manager where this is their specific remit. This is the job. This is what they've been doing for 20 years. So although those conversations are frustrating because often they are losses, they're sort of, I gave my mate down at the golf club 20 grand. It is sometimes a segue into a conversation about this, and therefore then they see, I suppose, a different route with a professionally managed service like an EIS fund manager as we have here today. But in terms of asset allocation, I think it goes back to Sanjay's point. You've got to look at the broader portfolio, and you've got to ensure that all your core building blocks are there, and then you start to look at what might be missing in terms of a growth element to a portfolio.
Sure. It's interesting where people get their advice from these days, isn't it? We've obviously seen over the last few months people taking advice from Instagrammers and TikTok and Reddit and things like that. So it's an increasingly, worryingly, I think, trend. But yeah, I am thinking of getting my own TikTok page. You don't have TikTok. See, I don't even know about TikTok. That's how much I know. There's not a TikTok page, is there? Might start my own TikTok advice service on EIS. But
Mark, I think many would pay to see you on TikTok. Yeah.
I was going to say an ESA TikTok. I'll definitely tune into that
I think
one.
my son would be devastated if I was on TikTok, so I'll probably avoid it for the moment. Jeffrey, I was going to talk about, moving on quickly, I was going to talk about correlated assets. So in my mind, EIS and SEIS is an uncorrelated asset to a normal portfolio. Well, I say normal portfolio, a normal client portfolio. Would you agree with that?
Yeah, absolutely. And I think Madeline touched on that very early on in the conversation. The size of the companies, size of the investments and the stages these companies are at makes it really, really robust. The classic example, of course, is coronavirus and this pandemic. And a lot of companies in our portfolio have been able to, ride that out, particularly or specifically because, a lot of these companies are used to operating on little or no revenue. So, being able to manage and negotiate this pandemic has not been as difficult as people would expect. Definitely is in terms of being correlated against the market, we have seen, it's particularly in our portfolio, that is the case.
Perfect. So we've got about 4 minutes left. I've got a couple of questions that have come through, but in terms of, I probably haven't got time to answer them, unfortunately. So I just want to go to each of you in turn and just ask you, if you were trying to kind of grow the EIS market, if you were trying to get more advisors into this market, what nice, sound, comforting messages would you put out there? Nick, I'll go to you first. Sorry, I haven't given you any time to think about it.
Thanks for that. I think the sound, comforting messages, be aware that the people involved in this that do have the time and the track record and tenure of doing this come to you with a track record and come to you with a scale of doing this over years. Don't lower your bar of expectation of how you should look at a fund manager in the same way you do as other parts of your investment process. See that there are opportunities, understand the risk, embrace the risk, be comforted perhaps by the tax to have that around you. I think sometimes you're like a heavyweight boxer that's going to get punched in the face occasionally, but you won't be knocked out. And you are the heavyweight though. You've got the big punch. And actually that's the nature of this investing, that it's all stacked in your favor, that your punches land and they land significantly. Whereas you're only taking a few jabs on the chin because of the tax reliefs. So if that's, you liked a cricketing analogy before, there's a sort of boxing analogy for you that, go in with it well trained with a strong team around you, but knowing that all the potential's on your side.
The Anthony Joshua investment.
Exactly.
Yeah, thank you. Neil, over to you.
I think using case studies is the most powerful tool that we have of the investee companies to help people to understand the sorts of company that you get exposure to when you go into EIS. And I have thoroughly enjoyed the last 6 months. It feels like it's been a really slow burn. Like I say, we've been doing EIS 7 years, and when we first launched, EIS was in this form through a managed service was still relatively new. So there weren't many well-known companies that had come through that route. Now, in the last 6 months, we've already heard about Kazoo, Active Ops, we've had Gusto, Bloom and Wild, Pastor Evangelists, all well-known brands now that people can actually see. They see it advertised on buses and on tubes, etc. And these are all businesses now that our clients have made really good money from because they backed them 3, 4, 5 years ago when actually no one had ever heard of them. And I think it's a really fantastic case study. And it's great. Someone mentioned earlier about it makes clients kind of almost feel like they're really savvy investors. And it is something they talk about down the pub because they can say, oh yeah, Pastor Evangelists, I was in them 2 years ago and they've just been sold for 50 million or whatever it was. And I think those sorts of case studies are really powerful. And I think the more we can communicate those and people understand the sorts of businesses they get exposure to, the more the level of interest in EIS will increase.
Sure. I think you're the only person that's enjoyed the last 6 months, Neil. But I take your point about the exits. Yeah, the investment, what the last 6 months has shown is that coronavirus has really condensed an EIS portfolio almost from 4, 5 years, 6 years into 3, 6 months. And it just shows that there's winners and losers. And just shows what the roller coaster journey is, I think, really. So it's been useful for that. But yeah, case studies.
There's been more ups and downs despite everything that's happened in the last year. We've generally seen investments grow over the last 12 months. Although clearly there have been some companies that have taken a bit of a hit. The success stories far outweigh them.
Absolutely. Madeline, I'll go to you next.
Yes, thank you. So I completely support both Nick and Neil's points. I think they're really valid there. They got in first. I would probably say don't underestimate the support of HMRC and the Treasury. They really do see the value in this. I mean, when we launched our UK Creative Content EIS Fund almost 2 years ago now, there were actually representatives from both those two institutions sitting around the table with us to help us plan out how the fund should fit. What should we do? What should we target? What should the timings be? So they contributed to the actual conception of the UK Creative Content EIS Fund. So the support that is there for EIS is really strong, and I don't think that should be underestimated.
Brilliant. Jeffrey, Sanjeev, I can ask you to keep yours slightly brief because we are at 11 o'clock, but yeah, thank you.
Just quickly, I'd just say, there are a lot of tools to help you do your research, and make sure you really understand the underlying managers properly and the investments that they invest into. And also, portfolio diversification is really important. So within each manager, there's portfolio diversification, but you can also consider diversifying across different managers. Lots of managers have different strategies, and doing that helps to smoothen out returns as well. Yeah,
spread your wealth. Absolutely. That's a good one. Sanjeev, last word to you.
Yeah, just building on all of those points before me, I think key thing on this is communication. We're operating in a market that has a lot of information asymmetry. So it's up to us as fund managers to make sure we're communicating as openly and transparently as possible. And actually that is getting people back in turn. So the more we communicate, the more we're getting people interested in actually coming in to invest with us.
Brilliant. Thank you very much. I failed to keep us to 11 o'clock since 11:01, so apologies for that. But it's been a really good session that we've gone over because we've had so much content. So thanks very much to our panelists for adding all their thoughts and contributions. It's been massively positive webinar, this one. So thank you. This is being recorded. It will be on the website in the next couple of days. So pick it up as you need to if you want to watch it again. Please do join us tomorrow. We have our last in a week when we'll be looking at some of we always talking to some entrepreneurs and getting them on and talking to them about why they work with VCs and how that relationship works and what they think of the investors who invest in their business. So again, should be a very interesting one. And don't forget, it's free membership of Visa for IFAs. So please do get on the website and have a look at that and sign up and do that. Just leaves me to say thanks very much to our panelists. Thanks to Neil, thanks to Nick, thanks to Madeline, thanks to Sanjeev, thanks to Jeffrey. I say we'll be back again at 10 o'clock tomorrow. Thank you very much.
Thanks, Mark.
Thank you. Bye.
Thank you. Bye.